Welcome, dear traders. Wall Street extended its losing streak. Yesterday, all three benchmark stock indexes dropped sharply. The Nasdaq saw bigger losses. On a Wednesday morning, the US stock futures managed to stabilize. Stock markets in Australia and Japan also slid into the red zone amid risk aversion. There have recently been more signs of a looming recession, so traders can no longer ignore them. For instance, an inverted yield curve is a clear sign of a downturn. In the last session, 2 and 10-year US Treasury yields inverted even more and reached a new 41-year low. When the 2-year US bond yield exceeds the 10-year US note yield, it's the classic harbinger of a recession. Although the strong non-farm payrolls report and the ISM services index signaled economic resilience and the likelihood of a further tightening, many analysts are still betting on a smaller rate hike in December. Recently, the market reaction to some technical indicators, economic reports, and the Fed policymakers' comments has been subdued. Sometimes traders ignored some speeches or macro stats to justify their strategies. However, they were unable to pay zero attention to dismal comments made by the largest banks. After several senior US banking executives warned of an impending slowdown in economic growth, risk appetite decreased significantly. Investors took notice of the grim remarks of a Goldman Sachs CEO David Solomon and JPMorgan CEO Jamie Dimon. Market sentiment on Wall Street turned sour following these speeches. They stressed that persistently high inflation could trigger recession in 2023. According to the latest data, inflation stands at 7.7%, which is quite far from the Fed's target of 2%. The Fed meeting is scheduled for next week. Currently, 77% of investors are anticipating a 50 basis point rate hike. It's quite curious given that unexpectedly stronger than expected data on the ISM non-manufacturing index and average hourly wages should have dispelled hopes for a dovish move at the end of 2022. Apart from a macro stats, the forecast of the top economists also darkened the economic outlook. As a result, the stocks were unable to withstand the bearish pressure. The US dollar took advantage of a risk aversion and climbed higher. However, its growth was rather modest. The fact is that the majority of speculators expect a smaller rate hike, which prevents the US dollar from a sharp rise. In the Asian session, the US dollar index advanced to 105.60 versus its main rivals. For a long period of time, the US dollar has been the undisputed leader on the Forex. However, in the case of a recession, the US dollar will plummet as well as the economy. So today, rather controversial factors are influencing its trajectory. Bears are trying to push it lower amid the possibility of a recession and the Fed's dovish move. However, its growth is facilitated by the risk of sentiment and hawkish expectations. In the Asian session, it was consolidating in the extremely narrow range of 105.50 and 105.80 due to a mixed fundamental background. Despite mixed drivers, the US dollar is still stronger than the yen. The latter was dragged down by Haruhiko Kuroda's dovish comments. The Bank of Japan governor excluded any chance of a policy reversal, saying that the regulator strives to achieve the 2% inflation target. It means that the yen's trajectory will hardly change until the expiration of Kuroda's term in April 2023. The Japanese currency will mainly depend on the US dollar's movements. In the Asian session, the dollar-yen pair was trading at 137.5. Judging by the technical indicators, the pair is likely to rise higher. The resistance level is located at 138.50. The pair may also touch the psychologically important level of 140. If the US currency loses momentum, the pair may reach the support level of 135.50 at the end of the day. The next level is seen at 133.50. On a Wednesday morning, the pair was moving in the upward range of 136.80 and 137.90. The Australian dollar is more sensitive to external factors. For this reason, it did not react sharply to the negative domestic economic report. Australia's GDP for the third quarter missed expectations, rising to 0.6%. However, there are plenty of downbeat external factors. Oil prices tumbled due to the strengthening of the US dollar, and this is a bearish factor for commodity currencies. There was also no positive news from China. Not long ago, the country announced the easing of some virus restrictions, boosting risk-sensitive currencies. China, Australia's main trading partner, revealed disappointing trade balance data. And this is hardly surprising that the Aussie eventually slid down. It dropped below 0.6700, approaching 0.6690. Bears are tightening their grip amid risk aversion. The AUD USD pair is moving in the downward range of 0.6674 and 0.6717. And that's all for now. Stay tuned and keep close tabs on the market developments with us. See you soon.